money is not wealth. Money is a claim on wealth. And if you make more claims on wealth, that doesn't mean there's any more wealth. It just means that there's now competition amongst claims. The key thing is that Bitcoin is not credit. Bitcoin is nobody else's liability. I make a point of saying exactly the following quite a lot. I have never and will never tell people to buy Bitcoin. I'm not doing that now. I've never done it before. I'll never do it in the future. What I say is that I strongly encourage people to learn about it. And honestly, my prediction is that if you learn about it enough, you'll want to buy some on your own.
Hey Alan, nice to see you today.
Thanks very much.
So I kind of, to get going, I'd love to give the readers a little background of who you are, because you started out kind of, as you like to say, burger flipping, was a software engineer at one point, went into the world of finance as an investment manager, and then went on to kind of write one of the most, I guess, well, not necessarily most, but one of the more advanced Bitcoin books, or the tougher ones to read. Yeah. So I'd love to kind of hear, you dig into your story a little bit and how you kind of ended up writing a book on Bitcoin.
Sure. Yeah. So my backstory, I guess, or like my origin story in all of this is, it's not really that exciting. I guess I've heard far more exciting ones, which have like a far more obvious light bulb moment, like something just
big epiphanies,
big, important happened, and suddenly, whoever it was like tumbling down the Bitcoin rabbit hole. In my case, it took a really long time. It was just a very slow burn, I guess. So for me, it would have started in, I think, around 2013 or 2014. I'm actually not even sure precisely when, because I remember what year I was in uni. Like that was the more important thing, rather than what month it was precisely. But it was either 2013 or 2014 when I first came across it, and I think I was just really, really lucky because I had almost a perfect background, or like a perfect set of influences that led me to basically not reject it. I'm very careful to not say like, oh, I completely understood it right away, because I'd say even in my case, I didn't come close to understanding for, I think, a couple of more years, but I didn't dismiss it, which I think is what the vast majority of people do. And even people who go on to be Bitcoiners themselves, and like quite prominent Bitcoiners, part of their story is like, oh, I came across it in whatever 2011, but I didn't take it seriously until 5 years later, and then 1000x in the meantime, or something like that. So not dismissing it was huge. And the handful of influences, you mentioned one already, is that the only like real job that I'd had at that point was as a software engineer, which I wasn't very good at, but still very helpful influence.
Nice.
Seriously. At the time, I was a student studying math and philosophy, so they're both independently very useful. I happened to be, just kind of completely coincidentally, I happened to be really well read in Austrian economics, which is also very helpful. And then the final one is maybe not as important as the others, but it's kind of, I guess, well, it's become important, maybe more for me, less so for being directly related to Bitcoin. But I had started a business when I was in uni, which also wasn't actually that good. It wasn't terrible, but I didn't continue with it. I didn't become a successful founder or anything like that. But just having had that experience of like dabbling in entrepreneurship, I think is also really helpful. When I graduated, though, I didn't keep that business going. I got a pretty normal, or at least on paper, a pretty normal job in finance, in TradFi, as Bitcoin people like to say. And that was probably, that would have been key actually for the Bitcoin journey, because it led to, I do remember this specifically, 2016 was the first time I actually bought some, because I was a very poor student for the previous part of that story. Once I got a bonus from that job, I was finally in a position to buy some, which I think is actually really important. It may not sound like that big a deal, I guess, maybe even more so for people who do actually have some experience in finance, because it's kind of ingrained. It's been sort of normalized now that you can just buy whatever you want, and your portfolio can change all the time. But I think Bitcoin is really very, very different partly because the bit of it that's most similar to regular finance is that it's just historically, at least, I don't think there's anything like deterministic about this, but historically it has been way, way more volatile than anything with, a similar-ish or a seemingly similar profile in terms of, if you're investing in it for the sake of technology or just risk in general, way, way more volatile than anything remotely similar in terms of how you might characterize it. But I think the even more important one, which doesn't compare to anything else in finance, is its completely unique nature as a digital bearer asset. So I actually think that this will maybe be useful, might be, I don't know, patting myself in the back too much, but some of the listeners may find this interesting if they're in this position, that I would argue if you have bought Bitcoin and you've just left it on an exchange, that's pretty much pointless. I mean, you may have done well financially, but you really haven't. There's a lot more to do to grasp its importance and to get involved, because completely unlike anything else that you could buy through such a service, you can take it off the exchange and you can self-custody it, and you can start to play with it yourself. I mean, the playing with it part obviously isn't all that financially important, but I think it is really behaviorally important just to understand, like to really appreciate how novel this is, and to start to get the ball rolling on what its implications might be. You need to take self-custody. You need to play around with it. You need to appreciate the importance of, what it is you're looking at and what you're doing. So yeah, so back to kind of rounding out my journey. So for me, that would have been about 2016. For a long time in this job, I won't bore the listeners with too much like financial jargon, I guess, but very briefly, what my job was just investing in companies, right? Like researching and investing in companies. And I think that was actually really beneficial in terms of my longer term Bitcoin journey, because it meant that I couldn't, for example, just get them to buy Bitcoin or say that they should, right? Because it's just not something that they did, because it's not a company. It meant on the one hand that even though I was quite, into it, and like I made that known, everybody knew that I had an interest in this, and I knew quite a lot about it. It just wasn't really relevant to my job for quite a long time. But in the longer term, it made me, not being able to just advocate to buy Bitcoin and kind of that's the end of it, forced me to think about how it would potentially one day be relevant for companies rather than just letting it go altogether. And it was a while before this did actually have anything to do with my job, but then I'd say probably 2021. So I've been there a long time at this point. And had a job on paper that was completely different to anything related to Bitcoin, even though I was known for this, and at that point as well, I had quite a big public profile that had been growing for a couple of years, just entirely on the side, like nothing really to do with my job. But in 2021, we had finally got to a point where there were big enough Bitcoin companies that it was worth not even necessarily investing in, but looking at, such that my relative expertise in this was finally useful. And things moved pretty quickly from that point, to be honest, because having gone so long without it being relevant, with it, it was purely a hobby. Even the public profile stuff was entirely outside of work. Once we had started, once I had started kind of dabbling in this, the way I like to describe it is it went from 0% of my time to, it's hard to even say, but still a very small amount, maybe like 5% or 10% or something. But that was enough to kind of get the taste for it, right? Like once I dipped my toe in the water, I very quickly thought, oh no, this is what I want to do all the time. Like now I actually know what this is like, because I just never had that experience before. I definitely want to be doing this all the time. And so last year, it's coming up on a year now, I left that role to set up a new company. Unfortunately, I can't say a huge amount about it because we're still in the process of like setting it up. We haven't made any public announcements or anything like that. But it's sort of easy enough to imagine what it's going to be. It's investing in Bitcoin companies. But all the time, that will be the only thing I'm doing now. And I kind of have been doing it in the background, but again, there's the setup process is long and painful because you'll be shocked to hear that regulators don't really like Bitcoin very much. So it's taken a bit longer than we had hoped, but there's light at the end of the tunnel.
Sounds like it could be a dream come true as things start to materialize some more.
Hopefully, yeah. It's definitely not that yet, but we have a low time preference, right? We're a very long time horizon, so we're not letting this bother us too much.
No. You mentioned bearer asset there, and I think when people first start kind of learning about Bitcoin and money, the difference between money and currency, and then I guess kind of a bearer asset, is something that people have never really thought about. In that currency, you just assume is money.
Yeah.
So could you kind of quickly touch on like the difference between the two, and why then you believe it's so important for people to maybe actually practice self-custodying it themselves?
Yeah, sure. I mean, actually, I don't mean to be avoiding the question too much, but I think there's kind of a higher level issue that's more interesting here that I'd rather address first and then come back to this, which is that there's a huge amount of, once you really start thinking about this, and for many people, Bitcoin is the catalyst to start thinking about it seriously, and they, as you say, right, they just never have before. You realize that there's a lot of really unhelpful semantics around how we talk about money that they're not completely random. They're not there just to confuse you. And it's not like a conspiracy or anything. It's just a product of the historical evolution, but which Bitcoin now challenges for the first time, or for the first time in any really meaningful way, probably for most people, alive today and who are thinking about it seriously. And so I'm actually not even sure that the distinction between money and currency, I think money and currency is one of these that isn't that helpful. I think the one that's more relevant to where you started off by being interested in the idea of it being a bearer asset is just between, it's actually not even a distinction. This is what's so hard about it. It's realizing what is and is not credit. I think that's the key thing. And this is almost so ingrained. It's so key to how fiat money actually works that it's a semantic thing again. It's difficult to come up with the right terminology to describe why Bitcoin is even different. But the key thing, so it's you end up describing a lot of it in the negative, basically, as I will now do. The key thing is that Bitcoin is not credit. Bitcoin is nobody else's liability, which might sound kind of weird because you'd think, okay, well, surely most things you own, unless they're like, explicitly debt, I guess, if you're on the other side of a loan that has been made, surely almost any financial instrument that you could have, is your own asset. But actually, in some cases, there's like a bit of dry accounting behind it, in the sense that, like if you own stock in a company, that is actually the company's liability. That's not really the kind of thing I mean. What's more interesting in digging into why that is true of fiat money that most people just don't appreciate at all, that I've started tweeting this a lot lately. I'm sure, as you mentioned, you want to get onto more contemporary events anyway, but I've been kind of sarcastically quote tweeting this in reply to a lot of much more famous people saying things about the current crisis that I just found amusing, because they don't seem to be fully aware of this distinction, that fiat money is a bank liability. So unless you have physical cash, which almost nobody does anymore because it's not very helpful. Basically, the vast majority of payments that need to be made cannot be done with cash, and certainly can't be done. Even physical cash is itself not really a bearer instrument. It's almost like or historically at least, it's a receipt for real money. But even then, like, you certainly can't be paying
real
people
money
with
being gold.
The vast majority of money flows are, but they're basically conducted between banks, even though that's not how the participants necessarily perceive them, until a bank suddenly goes bust and everyone's like, wait a minute, do we even have money anymore? Like, what's going on here? So that's the major difference with Bitcoin, that it is nobody else's liability. It is a pure asset. And that's why it's so interesting that you can, in fact, remove it from an exchange, because when it is still on an exchange, it is somebody's liability, right? You don't really have Bitcoin. You have a Bitcoin IOU. And we've seen this too in the past couple of years, right? Or especially in the last year. if an exchange goes bust, you don't actually have Bitcoin. You have a piece of paper that may turn out to be Bitcoin, but who knows? But the really interesting difference is that that's actually what you have even with regular money, and certainly with regular other kinds of financial instruments. They really are just IOUs that a custodian will hopefully honor. In the case of Bitcoin, you can actually have it yourself if you want to, and I would argue you should, or else what's the point?
And pretty much the only other option then, if you do want to completely own something, is to have like a gold bar under your bed, or something in your room. Which really leaves you limited
an
choices.
interesting comparison to make. Like, I think probably all Bitcoiners have gone through this thought process at one point. You certainly could do that. There's two key differences. One of them's a bit trivial, but it's useful to go over this intellectually, which is, how do you keep that secure? And probably most people actually could keep a gold bar secure, I guess. I don't have any particular advice on how to do that. I don't own any gold bars anymore. But it's an interesting comparison because the equivalent with Bitcoin is it's almost trivially easier in terms of the responsibility you're able to take for it. But then the far, far more important one, which has massive, how do you even put it? Implications in terms of analyzing the historical development of this, is that gold is very, very difficult to get involved with sufficiently complex commerce. And you can see, almost an immediate departure point where commerce gets complicated enough that it actually kind of falls back into the first question, that moving gold around and securing it becomes just not worth it, not worth the risk, or not worth the cost, or some combination of the two. And you move on to receipts on gold. And then, fast forward, 800 years or something, and you get where we are now, where there just isn't even any gold in the picture anymore. So that's the major difference, that even though, this is maybe even worth digging into in a little bit more detail, because I do think it's really fascinating, even though it's very, very easy to secure on your own, Bitcoin is, certainly relative to gold, probably relative to most things, because it's just information. Precisely because it's information, it's also just as easy, if not arguably easier, than fiat money to send it and to embed it in commerce. Well, so you kind of get the best of both worlds, provided
to actually send it, and it not just be a credit.
In the first
place. Yeah, definitely. And I guess by complicated commerce as well, you're basically just saying commerce that starts to move faster than you can move money almost. So as soon as you can start, say, transferring value, say over the phone, or like say today, you can buy a course. Like if you wanted to pay for that in gold, it's just not feasible to send that.
That's really interesting. That's actually not what I meant at all, but that's I guess a far better example, or, I mean, it's obviously a more contemporary example, but it's like where you get, if you push commerce to as, I guess, global now, but also kind of innately digital in a lot of respects. Obviously not every respect, you still need to buy physical things. What I was referring to actually was more like developments between, this is going to sound stupid, but I honestly mean this, between something like 800 and 600 years ago. That's when commerce started to become more complex than it was worth trying to move gold around. So we've come a long way since then. And you're right, we've come all the way to the point where you can now buy things that are purely digital, where you don't care and you may not even know where the seller is in the world. And so yes, obviously you can't send them gold.
Yeah. One thing I want to touch on was something that really, I read the Fiat Standard, and kind of the idea that finance kind of benefits simply because, well, it over really simplified, I guess, they have access to almost the cheapest interest rates relative to everyone else. And so in a world where money is being constantly printed, the ideal position is to always have debt. And then so if the group who has then the debt at the lowest interest rate then kind of disproportionately benefits over a long period of time. And I'd love to kind of hear because one thing that you said to me a while ago was one thing you're really excited about is the de-financialisation of everything kind of thing. Yeah. And so before digging into that, first, like why in your eyes has finance benefited so much? And then moving on from that, how do you see the de-financialisation playing out, and in what way does that impact society?
Okay, sure, yeah. So for the first question, how is finance benefited? I mean, you could spend hours talking about this. I think in the Fiat Standard Safe does spend at least one chapter talking about it, if I remember correctly. I'll try to give as simple an answer as possible, and it's basically something called the Cantillon effect, which is named after, I'm going to forget his first name now. I think it's Richard Cantillon, an 18th century economist who first identified it, allegedly, which is that when new credit is created, it is never distributed equally across all of the participants in, as much as I hate saying this, I feel it is kind of appropriate here, in an economy. It always goes to somebody first. And in the modern setup, that somebody is always the financial sector. And I guess there's two problems with this. So the way that the Cantillon effect itself is usually articulated is that credit or money, they're kind of interchangeable. Just going back to the point that all money now is credit anyway.
Yeah, could you quickly just elaborate briefly on how you would explain credit to someone? So I think people hear credit, debit, and that in itself can sometimes be confusing.
Basically, just when I want to make it sufficiently general. I don't want to just say like a loan, right? I want to make it sufficiently general that it can be obvious why money can be credit and why it is now credit. Something like when you have an arrangement with somebody who allows you to defer actually paying for something. So you can consume now, but agree to pay for it later. I think any arrangement where that is the case, where that's being enabled for you, is credit of some or other form. And so the reason I'm saying money is credit, and what I meant with most of what I said before along the lines of, all fiat money is a bank liability, is that all current money, so all pounds and dollars and so on, unless they're physical cash, which again is a tiny, tiny proportion, come into existence and then are, I guess, sustained, like their essence in some respect is to be the liability of a bank. So it's that a bank is basically promising to give you cash if you want it, although even that has now become, I guess, so corrupted or so weirdly toxic and self-referential that nobody even wants cash. What they like, the worst that this could come to, which again is interestingly contemporary, is that they want their liability moved to another bank, right? And which can have real implications. I am a bit wary that this maybe sounds all weirdly just made up and like not ultimately grounded in anything. There is a sense in which that's true, but it can, even with that in mind, it can't really escape these accounting identities, I suppose. So banks can still go bankrupt, as we've just seen. People will, in that case, want their money to no longer be the liability of that bank, because that's sort of what it means to be bankrupt, is that they can't pay you. They want the liability moved to another bank instead. So that's more or less what I mean in the context of money.
Nice.
But yeah, so to finish all that point, so what happens when you create more credit and or money, and especially when it gets put into the financial sector first, is that it will eventually trickle to everybody, right? Eventually the increase in the money supply will be evenly distributed, but only through economic interactions taking place, right? That's how the money will end up spreading. But the problem is that prices won't go up to reflect the increase in the supply until these trades happen, because people put up prices when they see behavior in the market changing. So what will happen is that as the money starts to spread, prices will start to go up, but the people who are the last to get the money will see the higher prices before they get any of the money. So it's basically I mean, other things happen as well. It's not only this, but it's basically a transfer of purchasing power from, I don't want to say the poor exactly, because that's not quite right, although there's a lot of overlap. It's more like a transfer of purchasing power from the least politically and financially connected to the most politically and financially connected. who tend to be rich, and the latter tend to be, or the former, sorry, tend to be poor, which adds I guess, a particularly insidious political component to it as well. So that's why it's not ideal. There was one other point I wanted to mention, just because I know that this is in the fiat standard. I know Safe likes to make this point. And I think it's a really helpful metaphor, because a lot of this maybe feels a bit jargony and abstract, that what this is like when this happens, when you issue more credit that isn't actually backed by anything. It's as if you have a stadium, a football stadium, for example, and your attitude to how you're going to make more money from this, like say you own it, right? Like you're the football club, I guess. Your attitude to how you're going to make more money from the stadium is not that you're going to build more seats such that more people can attend the games. It's that you're just going to sell more tickets, right? Which is fine to start with. Like, you get more money right away. But then when the game happens, these tickets aren't worth anything. You know, some of them aren't going to be worth anything because there aren't enough real assets to back these claims. And in that sense, you know, that the reason this works so well as a metaphor is that a metaphor specifically for money, not just for why this is like a bad idea, is that people don't tend to think of money as being credit. That's kind of what makes this all feel so wrong. They tend to think of it as just being a claim, or they probably don't even get into that much kind of abstract detail, right? They don't really think about it at all. It's like, this is worth what it's worth, and that should be fine. Similar with a ticket, right? You don't think of a ticket to a game as being uncertain in any way, or like a credit instrument in any way. You know, it's not like an IOU for some game at some point. It's like you think of it as an asset. You think of something that you've bought, and then you're going to go and redeem it. And that's just not how it works, unfortunately.
I really like that analogy. It's kind of like, I don't know, I guess it's that ticket means that you get X tickets. So say, I don't know, if you want to say this note can buy you a house, but then you start increasing how many notes there are, but not how many houses, there's not going to be enough houses, and you're going to be able to buy less house with your note, even though you originally thought that you might be able to buy X amount, which is basically then what you see today. And it's so interesting when I first start talking to people about this, I'm like, okay, so what is money? Or like, what is inflation? Like, why do we have it? And they're like, literally, the people talk about it, but at the moment it's like a hot topic. But then the why is kind of like so elusive that it takes you from one thing, and it's like, oh, it's like X group. It's like, oh, it's this group. It's kind of, I mean, there's obviously other factors as well, like energy and that sort of stuff. But then, fundamentally, it's the things that you use to buy something else. They're increasing in supply, and the things you actually want are kind of staying the same. So the amount.
There's another good line that Safe has that. This one, he did come up with a stadium analogy, as far as I'm aware. This is more just like obviously true, but he says it a lot. He's kind of popularized it, which is just that money is not wealth. Money is a claim on wealth. And this is obviously linked to the stadium. It kind of explains it maybe at an even deeper level. If you make more claims on wealth, that doesn't mean there's any more wealth. It just means that there's now competition amongst claims.
You said kind of that so basically the reason why finance benefits is because they get the money first. Why? Yeah. Why do they get the money first?
And they get to flip it into real assets before anybody else.
But why? How would you say, if someone's like, but why do they get it first, or how does it filter to them first rather than other people? How would you explain that?
Oh yeah, I mean, it's kind of simple, but provided you already understand enough about banking. If you don't, unfortunately, I don't think it's really that easy to explain. I mean, that if you have fully grasped, you know, the nature of money, of fiat money as being a bank liability, then it follows pretty straightforwardly, I guess, that the mechanism, and to be fair, there's more than one, so even that can get a bit complicated, but collectively, the various mechanisms for increasing the money supply invariably mean, whether it's banks or in some cases it could be more like asset management type institutions, they get the money first. And even if the intention is to give it to someone else, so this is one of the weirdest things. So like, as an example, like in COVID, where we had this idea of, oh, we'll just do like helicopter money, right? People aren't working, so we'll just give them money to keep them going because it's an emergency, right? Entirely leaving aside whether you think that's, sound or not politically, just focusing on the economics of that. The only way to do that is to put it into their bank accounts, right? Because again, you can't really, this is again back to this thing of like, you could do it with cash in theory, but it's completely impractical because again,
postman will have a tough
the
time.
ways that we use money are not physical anymore. So you have to put it into people's bank accounts, but then it's the banks. It's not theirs. All the people have is an IOU from the bank. And so, I mean, luckily this didn't happen. It doesn't happen that often, so I don't mean to be sounding too kind of alarmist or anything, but it is an interesting thought experiment. Like, what if this stuff with Silicon Valley Bank was happening at the exact same time as the stimulus checks in the US for COVID, right? Like, as in, what if the federal government said, okay, everybody gets whatever it was, like $1,200, something like that, and it goes into your bank account, but then your bank goes bankrupt. And on like the same day or the same week or whatever, you're like, so wait, do I have the money? I'm not sure anymore. So sorry, I'm kind of going back into the same answer as before, but to directly answer the question, is that because money is, or fiat money rather, is a bank liability, there is no way of increasing the money supply. No matter how creative you get, you're ultimately going to have to come back to, we need to put more into finance. We need to, first of all, just invent the money, just like, print it out of nothing and put it into financial institutions so that the people we actually have in mind who want to benefit from it, or who we want to benefit from it rather, will eventually get it. Unless you want to mail them cash, there's no other way of doing it.
It's kind of like, I don't know, say a business in the county that I'm at the moment, the money doesn't generally come straight from the government to the business. It goes first maybe like the Welsh Assembly, and maybe to the council, and then, I mean, it's slightly different, but then it finally ends up with the person, but there's not really a way to with the business to kind of say, put that grant straight through to them. It has to go through these things first.
Yeah.
And given that money, as you say, is completely a liability of the bank, it's something that the bank owes you, there is no way. Yeah, that's a great way of putting it. There's no way that someone can get it without it going through them first. It's like the ultimate middleman, I guess. And I guess this kind of ties into then the second part of the question, in that why are you excited about de-financialisation / why do you think it will happen? And I guess it's because you see us transitioning away from this fiat system to the more Bitcoin system, where the money doesn't have to go through these institutions to get to you first.
Yes. There's a couple of answers. I think the most obvious one, just because we've covered this point a few times, is that Bitcoin does not have these characteristics, right? You can actually hold Bitcoin yourself with no counterparty risk because it is nobody's liability. So that in itself is just nice, even before you get into, how this might be relevant to finance. It seems to be like an obvious good that you're not, especially if you think of it as, this is a good segue actually into more complex issues within finance, but if you think of it as savings, right, which is, this debate is now coming up a lot in the US, as in right now, this week, because of how, determining what the politically appropriate response to Silicon Valley Bank is, given that people think of their assets people think of the bank's assets as belonging to them. They didn't think that they were signing up for like punting around in securities markets, but the nature of fiat banking is such that actually they had no choice. So, who do you make whole and why? And so I don't want to get too into that now, because I know you want to come to that later. But just that not existing for people who don't want it, for people who just want to save money, basically people who want to, like, in another world, in another time, I guess, would have the gold bar, or would, stuff money under their mattress. They want a way of doing that, or they'll have, I guess, a way of doing that is actually akin to having it in the bank, which is the other weird thing about it. So this whole, shoving money under the mattress is usually presented, I don't know if anyone actually does this, to be honest, but whenever it's talked about, right, whenever it's used as an example of whatever, well, what it is used as an example of tends to be alarmism. But not like completely crazy alarmism, just, what you would do if you were deeply, deeply suspicious of banks.
It's an insurance policy.
Yeah, it's kind of like insurance. Yeah. And it's interesting because it is obviously inconvenient, right? Whatever those savings are, you're taking them out of any ability to really use them as money. They're now purely savings, right? I suppose you can take the cash out a bit at a time to pay for stuff, but this is back to the same point about, like, you can't really engage in finance at that point. Whereas again, with Bitcoin, you can, like, the equivalent, you're getting the best of both worlds, right? You can actually save it in a way that it's nobody's liability. There's no counterparty risk, but you're in no way removed from being able to send it basically wherever you want in the world instantly, and therefore engaging in more complicated finance if you want to. So that's the nice segue. That I think the main difference in terms of how finance operates will be that actually I can think of two things, sorry. So one's more like philosophical and one's a bit more practical. Philosophical one is that it will be entirely opt-in, right? There will be no assumption that you have to do this, and hence there will be no moral hazard either, because if you want to engage in finance, it'll be entirely your own responsibility. You won't end up in the situation, again, that we're currently seeing with Silicon Valley Bank, where people are, the depositors are like, wait a minute, I didn't want to be taking these risks. I just wanted to have a savings account. And then if you push out a bit further, obviously, I guess that was last week. What's actually happening now is more like, well, what's the moral hazard of bailing out not the bank itself, not the equity holders in the bank, but the depositors? Because, there is a somewhat misnamed, I guess, deposit insurance policy in the US. And it seems like what they've decided is that, screw that, that doesn't matter. Everything is insured. And then you get to, well, then what's the point of deposit insurance? And, what precedent does this set for everyone else that actually you can now do whatever you want and there's no consequences? So you basically just remove all of that, right? You allow people to take exactly the risks that you want them to in the first place, that they want to in the first place. That's the philosophical part. The practical part, I think, actually also links nicely in a way to the current mess, in that it'll be a lot more obvious that banks are essentially asset management businesses. So that is currently the case, but in a way that is deeply confusing for most people. I think just not widely understood at all, precisely because currently, we have, or apparently we have banks on the one hand, like that's one sector of finance, and then we have asset management, which is a completely different sector. Basically, the difference is that asset management is set up to not have maturity mismatches. So what I mean by that is not have, actually, I'm not sure how much detail I want to explain this in. Basically, when you give money to an asset manager, there are very clear terms about how you can get it back. And in getting it back, you don't disadvantage anybody else. So it's not like a bank where, again, you have this essentially false assumption that, you just take the money whenever you want. Because in the case of a bank, their liability, this is what it means to be a maturity mismatch. I may as well just explain this. Their liabilities, which is what they owe you, have a maturity of 0, which means they can be called at any time. And their assets, which is what they're investing in, have potentially a very long maturity, right? They again, this is what happened with Silicon Valley Bank.
Locked up.
Sorry?
The assets are locked up in a sense.
Yeah, basically, yeah. It's very difficult to liquidate them. And so if enough people, this is like the essence of a bank run, if enough people want their cash back now, everyone is screwed because the bank can't get it quickly enough. So that we have this distinction in modern finance, which is basically between, like almost real asset management in a way, where it's clear that you don't have cash, you have an investment, and you may not get it back right away because there's no maturity mismatch. And there's no, this is, again, sorry for being mildly technical here, but there's no fractional reserve either, which means that they have exactly, the asset managers have exactly as much assets as they do liabilities, which is another problem with banks. Almost every, in fact, probably
and
every.
you earn a clear return. You earn a clear return from the asset management in the real world, in the real asset management as well.
Yes. Yeah. Exactly. Yeah, yeah. So it's all of the incentives are far clearer in asset management, in contemporary fiat asset management, than they are in banking. And banking's just a leveraged, morally hazardous mess. And so I think the main difference, so operationally this time rather than philosophically, is that it'll be a lot more obvious that almost, actually probably literally every mode of financial intermediation will be asset management. So there will be no fractional reserve and there will be no maturity mismatch. And it'll be entirely clear what risks you are taking, which aligns really nicely with the philosophical point, which was, you can take whatever risks you want. You don't have to take any risks that you don't want to take. So it's nice that, it'll also be clear what risks you're taking, and you won't, because you can still imagine, right? Like, okay, you don't want to take risks, but you end up doing it by accident because, I don't know, some kind of opaque information or whatever. But I think that even if that kind of thing were possible, any business that did it would immediately fail. And you will succeed. This is another interesting one, actually. This is almost the exact inverse of moral hazard. You will succeed in a Bitcoin centric financial services business by stripping away moral hazard to the best of your ability and being as transparent as possible with your customers, which is, I think, is obviously good. I can't see why anybody would object to that.
And I think that's the other distinction as well. Like, you often see Bitcoin only exchanges, they don't urge you to hold assets on their exchange. They're like, no, take it away, like store it in your cold storage. That's not, we don't want you to we don't want you to take on that risk, which is another completely different I guess distinction as well. So then kind of we've been flirting around Silicon Valley Bank quite a bit here, and I know you've been following it closely. Can I just get your basically your whole like overarching take on what's happened, and then what the kind of the larger implications you think are?
Okay, sure. I mean, I can probably deal with the second one first, just to not mislead anyone about it. I really have no idea what the implications are going to be. I think that's kind of, that's pretty core to any such crisis like this that has historically, or could in theory, soon potentially could unravel in a fiat banking system. The reason it's a crisis in the first place is that it's largely driven by, or in the moment, if you ignore the structural issues, it's in the moment, it's driven by fear. And so I'd actually be very wary of anyone who thinks they can predict precisely what the consequences are going to be, because they're essentially saying they know how, maybe not everyone else in the world, but everyone connected to this enormous, intricate banking system, how they're going to think and how they're going to act and how they're all going to react to what one another do. Like it quite quickly, I think, gets pretty preposterous. I think the far better approach is to just ensure that whatever happens, you'll be okay. But yeah, just to get out of the way, I have no idea what the consequences are going to be. But in terms of what actually happened, it's basically really simple. Or at least what's happened recently is very simple. I guess probably the best way to do it is to just, as concisely as possible, say with no commentary what happened, and then we can kind of get stuck into like why this happened and what's the connection to Bitcoin and so on. So what happened is that Silicon Valley Bank, they're predominant, I think not exclusively, but predominantly they're a deposit bank for Silicon Valley companies, unsurprisingly. Silicon Valley companies got a massive cash injection across 2020 and 2021 because a huge amount of the stimulus efforts, in some cases directly in terms of encouraging investment, and then in other cases more, I guess, insidiously in some sense by the persistent lowering of rates, pushing institutional investors further down the risk curve to chase yield, led to massive infusion into venture capital. So these numbers won't be exactly right, but something like, I think Silicon Valley Bank had, in 2020, they had something like $60 billion of deposits. And then just before it imploded, that had gone up to more like 200 billion. That's not exactly right, but it's kind of rough orders of magnitude are right. And the problem there is that, as this was happening, they just didn't have anywhere to put it. really, that and it raises this kind of almost bizarre philosophical question, but which thankfully we've covered enough on this for it to hopefully to click quite quickly, which is that it has to go somewhere. It can't, like, there's no such thing as them just holding dollars. Like, the only thing that could possibly mean would be like they put it in another bank, but that doesn't answer the question, because it's like, okay, well, what does that bank do with it? It has to actually go into something, because money is a bank liability. There's no such thing as just dollars. So what they did, to be fair, I think it's now coming out that exactly what they chose to do was particularly stupid. So maybe this particular case could have been avoided. But the problem is definitely a structural one. What they did was put it in, or not all of it, but they put enough of it into a combination of very long dated treasuries, so US government debt, and mortgage-backed securities. But they did this at basically the worst possible timing in terms of what the Fed was doing with interest rates, and somewhat inexplicably, they didn't hedge it, as in they didn't also buy any kind of instruments that would offset unfavorable movements in interest rates. So the reason this is relevant is that obviously now the Fed is trying to tighten and immediately failing, and not just Silicon Valley Bank, actually, there are many, many others in a similar position, but for them it was worse. They took massive unrealized losses on their treasury portfolio. And so this immediately brings both the problems I cited before that won't be the case in, I'm into the commentary now, right? That's basically what happened. That won't be the case in Bitcoin-centric finance, the fractional reserve element and the maturity mismatch element. They both now become massive problems, provided, or I guess they could potentially not be problems provided there isn't a bank run, but they caused the bank run that then made it a problem that then within a couple of days the whole thing fell apart. So what happened was they had these massive unrealized losses, which what I mean by that is basically they have these assets, these very long dated treasuries that because of interest rate movements are now worth way less than they've bought, or than they were worth when they bought them.
Because it rises when like the interest rate. Just to clarify, so when the interest rate rises, the asset itself decreases in value, or with bond, yeah. So that to kind of, I think that's basically a lot of people get confused on.
I think these numbers are like roughly right. Again, they won't be exactly right, but they bought these 10-year treasury bonds when the yield on them was something like 1.5%, and the yield on them now is 4.5%. So who's going to buy them? They're not. They're going to buy the 4.5% one. So obviously the price is going to go down. There's the demand for these just evaporates. So yeah, so that's basically what happened. That's not in and of itself a problem, because they, again, basically all of it comes back to like, provided there's no bank run, it's not a problem. But then a couple of things happen in quick succession, and I think as if not hedging it wasn't stupid enough, their communications around it were also really stupid and arguably triggered the bank run. They sold quite a lot of these at a loss in order to ensure they still had some liquidity in case of a bank run, which is quite funny. But they then have to report this, right? Because they're a public company. So they report that they have this now realized loss because they've sold all these securities, and that they're going to raise equity to cover the loss. And basically everybody just shits themselves and starts taking money out of the bank, and you get both problems at the same time. So the fractional reserve problem is that they don't have everybody's money. They only have a fraction in reserve of everybody's money. And so once that goes out the door, they have to start liquidating even more. And remember, they liquidated the easiest things to liquidate that actually started this problem in the first place. But because of the maturity mismatch, which is the other issue, that's not really feasible, because if everybody's trying to get the money out right now, in some cases, it may not even be possible to sell the assets, but because they're longer dated, they're relatively illiquid, certainly illiquid compared to people who want their money right now. Trying to sell them all at the same time means that you get less again than they're actually worth. And this all just becomes self-reinforcing, because as this becomes known, people, and then there's then like a game theoretic element to it where the depositors are thinking, oh shit, if I don't get my money out now, someone else will get it out, and then I'll have nothing. But everybody thinks that, so everyone tries to get it out at the same time. And this happened in the space of like 3 days or something, maybe even 2 days. I think it was like Thursday and Friday of last week was when this all unraveled. And yeah, I think it's good that we've actually covered enough that I don't really need to explain the opposite. In a Bitcoin centric world, there'd be no maturity mismatched, fractionally reserved banking in the first place. Some people would just hold their own Bitcoin and that would be fine. The people who want to take the risks would engage in something that is far more transparently labeled as asset management, and neither of these characteristics would be involved, and this just would not be possible.
And as a bank, if you do have a sizable amount of Bitcoin, there's no reason in particular not to just keep it in Bitcoin anyway, and not to be forced to protect yourself from inflation.
Yeah, that's an interesting question, actually. I don't really have a good answer to this. I'm not sure it's really possible to know this. It's more just, people have their own hypotheses, I guess. I don't know whether there will be any point in any financial institutions holding Bitcoin. Like at the very end of, like 100 years, say, maybe, obviously in the interim, there very probably is a good argument that they should hold some. But in like, I don't know if your listeners have heard this term, but in a hyper Bitcoinized world, right, which is basically like when it's all over, there's no fiat left anymore, it's just Bitcoin. I'm not sure there's going to be any point in financial institutions having Bitcoin, except maybe like a little bit as a cash buffer, because you'd immediately face this really interesting argument of like, why would anybody pay them for that? You can do that yourself. Like their job isn't to just hold it for you. It's to apply their judgment in, intermediating savings and investments. And that's back into like, okay, well, that's clearly asset management. It's not banking. I mean, you could maybe argue that like, I guess to some extent this does exist today where some Bitcoin holding is big enough, and I'm not even sure what the right way to describe this would be, like contentious enough or something to that effect, where it's not just like one person, it's not like an individual's responsibility. Maybe it's like a corporate treasury or something, and you need a more complex setup to ensure it doesn't get stolen, and for legal reasons effectively, or like avoiding liability from shareholders, you use a custodian. I can imagine that kind of thing exists. That does exist already, right? There are massive business, like BitGo and NYDIG do this. Coinbase does it to some extent as well, although it's not what they're best known for, obviously. I can see that existing. That in itself is actually super interesting historically, because you're almost unwinding the historical development of banking at that point. You're like, okay, well, we can now remove all this. You can strip out maturity mismatch. You strip out fractional reserve. There's no more moral hazard. There's payments still work though, so that's good. You get right back to the beginning of like, okay, well, what do people even really want? Like if they could choose on their own, what would they do with the Bitcoin? And yeah, maybe that's a good use case for some people, but they don't have to do it. That's the really nice difference. Some, even in those cases, some like a corporate treasury, they could decide to do it on their own. Probably won't, but they could. So then that gets into just, I'll wrap up on this. I'm just kind of jumping all over the place. That then gets into the really nice practical element of, okay, but whoever provides that service, it'll be entirely opt-in. They'll have to be completely transparent with the customer to even get their business in the first place, because nobody has to use them. So that's good. That's nice, fair.
And it ties into kind of I guess you're trying to really, really simplify things as to why you shouldn't just dismiss Bitcoin. It's kind of like something that couldn't be done at all before, a choice that didn't exist before, all of a sudden does exist. And that in and of itself has huge implications way further down the line. And I know you've got to head off now. So, yeah, you're probably watching the clock. So do you have any I guess just...
Oh, yeah, no, I do, unfortunately, yeah. Oh, that's a shame. Yeah. I'm sure we can keep going for hours.
Yeah, definitely. There's so many. I mean, I've got so many other questions. So I guess what are your kind of just final thoughts to kind of listeners, readers, and just do you have any final things to kind of leave them
Yeah,
with?
no, I think I have a really nice one I can say. I make a point of saying exactly the following quite a lot, usually when I'm on stage, like at a conference or something like that. But I think given exactly the discussion we've had, and then also the fact that I mean, my impression is probably most of your listeners aren't like all that familiar with this. I'm sure they've heard of it, but this isn't a Bitcoin podcast, right? I think with that in mind, the discussion we've had is a really appropriate time to say this, that I have never and will never tell people to buy Bitcoin. I'm not doing that now. I've never done it before. I'll never do it in the future. What I say is that I strongly encourage people to learn about it. And honestly, my prediction is that if you learn about it enough, you'll want to buy some on your own. So that's what I'll leave the listeners with.
Nice. Great takeaway. Thank you, Alan. It's been an absolute pleasure picking your brains and speaking to you.
Yeah, likewise. Thanks so much for having me on.
Thank you.